Today is Monday, February 24th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Alan Bush, ADMIS Senior Financial Economist, and Mark Bowman, ADMIS Senior Global Market Analyst. Starting with the grain markets this morning, Mark, and talking about corn. What's been the cause for the recent downturn in corn prices?
Well, I think there's a number of things that have contributed to the recent sell-off. First off, South American weather. In Brazil, we've seen drier conditions across much of the central and west central growing regions the past few weeks. This has enabled their second corn plantings to have picked up rather significantly. They've advanced about 30% last week to 64%. It still trails a year-ago pace of 73%. However, it has significantly narrowed that gap, which will enable a larger portion of the crop to hit its key reproductive stage before the dry season later this spring. Also in Argentina, we've seen real heavy rains across some of the key growing areas in the central part of that country over the weekend, expected to stretch into this week as well. Some of these rains will reach up into the northern areas. However, that area is expected to remain in a drier than normal pattern, however, but it should at least help stabilize conditions there across the key growing areas. Also, we have a USDA Outlook conference later this week. That's expected to show corn acres here in the U.S. in 2025 will expand about 3 million over what we saw last year. This as a result of the a poll here conducted by Bloomberg. We're also hearing increased tariff talk from the Trump administration. They plan to impose up to $1 million fee on Chinese-built vessels transporting goods here into the U.S. So I think it just continues to suggest that we're not going to see any trade agreement with China anytime soon. And finally, we just continue to see a buildup of speculative longs in the corn market, making us vulnerable to some long liquidation here. Money managers have been buyers 8 of the last 9 weeks, and index funds, they've been net buyers for 8 consecutive weeks, so extending these long positions to the biggest levels that we've seen in about 3 years. Demand remains strong, however, so I would expect May futures to probably find some pretty good support here before reaching the February low at 485.
Hey, Mark, we're also seeing some volatility in the wheat complex. What's triggered this recent volatility?
Well, I think the biggest factor driving the volatility, at least a run-up here in the first half of February, was the Arctic outbreak that we saw here across much of the nation's midsection. Low temperatures did dip to sub-freezing temperatures as far south as northern Texas for a number of days last week. That enthusiasm, is quickly wearing off. However, we did see a protective layer of snow ahead of this Arctic outbreak, so I think that's likely limited any damage to the winter wheat crop. Significant warming this week now, combined with a wetter outlook here as we flip the calendar over into March, I think is boding well for the winter wheat crop going forward. And from a speculative standpoint, we're pretty much seeing the exact opposite of what we saw in corn. Money managers, they were holding a very large short position in the wheat complex. They've been net buyers now for the past 3 weeks, covering about 85,000 contracts in the process. They're still holding a net short position of about 90,000 across all 3 classes combined, but that's the smallest short position in 3 months. Export demand, remains strong. However, without a more threatening U.S. forecast, we've seen prices now fall back below the $6 level again for spot Chicago. There too, I think we're going to probably see this continue to erode, but look for good support here around that February low at 560.
Thanks, Mark. Alan, looking at the finances this morning, can you provide a price outlook for 3 things? Gold,
Sure.
the U.S. dollar, and stock index futures?
Okay, well, first of all, gold futures today, in fact, the April contract advanced to a new record high this morning before some profit taking set in. It's still higher on the day. Much of the strength in gold can be linked to flight to quality buying and also buying from central banks. In fact, if anything, they have increased their buying. Also, there has been a flow of gold from Europe and Asia to the U.S., so that has caused gold leasing rates to actually increase. So that is a sign of scarcity, all of which points to higher prices for the gold market. So substantial gains for gold have taken place despite increasing prospects of the Fed likely to be slow to add more accommodation. Still looks like the Fed will remain on hold at the March and May meetings, but according to the work I'm doing, the Fed will cut at the June meeting. So on balance, it seems like the fundamentals continue to support gold and higher prices are likely. Interest rate markets, I think we'll probably see the front end of the curve futures coming under some pressure. I think the long end of the curve futures should continue to advance. The dollar index has underperformed the news as interest rate differential expectations are not helping as flight to quality longs are being liquidated. So I don't see a lot to do in the currency markets. However, I think there are better opportunities in stock index futures, which are holding up very well despite recent comments from Fed officials suggesting that they are likely to be slow to move to more accommodation. So I think a stronger U.S. economy will sustain stock market gains despite what we saw on Friday with that break. So on balance, the fundamentals still appear to be supportive to the stock index futures.
And Alan, any big reports that traders are gearing up for this week?
Yes, they are, and they all come at the end of the week. Thursday, we have the fourth quarter GDP revision, guessed at up 2.3%. And then Friday, personal consumption expenditures. That is the Fed's preferred inflation gauge. So it's the price index guessed at up 0.4%. So of those two reports, maybe the personal consumption expenditures that has the most market impact.
Thank you. Mark Bowman, in the wake of the sell-off here in cocoa, what do you expect from the ICCO report this week?
So the ICCO is the International Cocoa Organization, and they do quarterly updates on global production and usage. And this one will be their first official estimate for 24-25. They tend to be backward looking. You know, we've already gone through most of the, well, half of the 24-25 season already. But we've had 3 straight years of global production deficits. In 2021-22 was 216,000 tons. Next year was 64,000. And then in 23-24 was 478,000. So there are general expectations that there will be another deficit in 24-25. Production certainly has improved over last year, but not back to the previous year's levels. And another factor driving these deficits has been strong demand, especially emerging demand in Asia. Now, with the prices going to all-time highs last year and this year, or this year and the previous year, some of that demand has been capped. But overall, the quarterly grindings numbers have been better than expected. Last year's ending stocks were 1.3 million tons, which was the tightest since 1987. And the stocks to grind ratio was 27%, which is the lowest since 1976. Hence this move to all-time highs. Last year's production was 4.382 million tons. Now, if you average last year and the year before was a pretty good year, the average was 4.7 million tons. However, grinds last year were 4.8 million tons. So even if we have a decent production, unless we see grind fall out, we could still have a small deficit this year.
And Mark, let's look at cotton. What do you look for in the USDA Outlook Forum in regard to the cotton plantings number?
Okay, so Mark already mentioned that. Now for cotton, first thing, last week, the U.S. Cotton Council, which is an industry group, forecast a 14.5% decline in cotton plantings this year. Now, last year's plantings were 11.2 million acres. Last year, the Outlook Forum had 11 even, so they're pretty close. And it was off and on. The prospective plantings number was 10.7, and the planted acreage was 11.7. So if we look at the number this week, if we look at a 5% decline from a year ago, that would be 10.6 million acres. A 10% decline would be 10.1%, and a 15%, 10.1 million, and a 15% would be 9.5 million. Now, on top of that, we've got low prices, we've got poor export pace, we got the threat of tariffs, we've got competition from Brazil, and we've got China having a better crop last year than this year, so they didn't need it as much. And this would seem to me to put the 9.5 million number in as a realistic forecast. The low prices do mean the market is going to have to bid higher for acres at some point if it wants to get those.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.